Imagine planning your entire fleet strategy around a price crash that just never comes. That's the curveball Manheim's mid-February data has thrown at small and mid-size fleets this year.
I know, right? If you're still waiting for used vehicle values to tank, you're probably missing the real story. The numbers aren't just holding, they're stabilizing at a much higher level. And for folks managing work trucks, vans, or service vehicles, that matters in the wholesale lanes right now.
On today's episode, we'll break down exactly what the new Manheim Used Vehicle Value Index means for your fleet, not just in theory, but in every trade and replacement decision you make this year.
We'll get into why prices are more resilient than expected, how real demand and tax refunds are shaping the market, what's shifting with EVs and supply, and, most importantly, how to turn all this into actionable steps for your 2026 game plan.
So whether you're steering a dozen vehicles or a few hundred, stay tuned. We're unpacking the trends, pitfalls, and opportunities hiding in those February numbers and how Alliance Fleet Solutions can help you turn data into dollars. Let's dig into those headline numbers first. Manheim's index landed at 210 inches mid-February. Seasonally adjusted, that's down just 0.2% from January, but still up nearly 3% year over year. And the raw numbers? Up even more, almost double the normal February bounce.
Exactly, and that's not just spreadsheet trivia. It means the usual early spring uptick is hitting harder and sooner. I've talked to a few small fleet managers who were holding out for a big price slide, but the lanes tell a different story. Buyers are still saying yes at healthy rates, and depreciation has actually been a little milder than normal.
What really stands out is those conversion rates. Over 62% of vehicles are selling at auction, which is nearly 3 points higher than a year ago. That signals real demand, not just dealers fishing for deals.
And don't overlook the tax refund impact. Early IRS data shows refunds averaging 11% higher than last year, so buyers have more cash in hand. Pair that with slightly lower auto loan rates forecast for 2026, and you've got a market where retail demand is actually supporting your fleet's used exits.
So if you're budgeting for a huge drop or still running your vehicles into the ground hoping for better days, you might be setting yourself up for disappointment. The market's functioning, not falling apart. That actually reminds me the Manheim data isn't just about the big averages. There are some pretty sharp differences by segment and powertrain. For example, luxury vehicles are still leading the index, while traditional sedans are the ones really feeling the pinch.
That's a huge point. If your fleet leans toward higher spec or near luxury trims, you might still see some strong resale. But if you're sitting on a lot of basic sedans, don't count on last year's numbers repeating.
And EVs, everyone keeps asking if they're still a risky bet. The index shows EV values up 1.7% year over year and stabilizing after a rocky patch, while non-EVs are up 2.5%. So EVs aren't crashing, but they're definitely not a shortcut to cheap fleet values either.
It's more like predictability than a bargain. If you're thinking about adding EVs or hybrids for certain routes, at least you're not stepping onto a falling elevator anymore. But you still have to be realistic about who's buying on the other end. Segment really matters.
Funny you mention who's buying because the supply side is just as balanced. January ended with 27 days of wholesale supply, barely changed from last year, and only a tiny uptick by mid-February. That's nowhere near a flooded market.
Yeah, and with conversions and values both holding strong, it's not a fire sale environment. But it cuts both ways. If you're sloppy as a buyer right now, you can still easily overpay. The market's healthy, not desperate.
So the takeaway? This isn't a time to wait for bargains that may never show up, but it's also not a seller's fantasy. Smart, disciplined decisions matter more than ever, whether you're selling into strength or eyeing used acquisitions. All right, let's make it practical. For anyone listening who needs to right-size their 2026 plan, what's your move with this data?
Start by reviewing your replacement queue now, not 6 months from now. Use total cost of ownership, not just age, so factor in repairs, downtime, fuel, tires, and the real resale you could get today.
And when it comes time to remarket, target units that are still attractive to retail buyers. Reasonable miles, good condition, clean history. Don't run vehicles until they're only fit for auction bottom feeders. That's where margin disappears fastest.
If you're acquiring, don't chase every price uptick. Stick to your TCO numbers, watch segment trends closely, and keep a sharp eye on the evolving gap between EV and non-EV values. Update your budget assumptions too. Don't get stuck using last year's playbook in a changing market.
Let's wrap up with 3 big takeaways. First, used vehicle values in 2026 aren't dropping off a cliff, they're stabilizing at a new, higher normal. Second, real demand and healthier tax refunds are keeping the market strong, not fragile. Third, not all vehicles are equal segment and condition will seriously impact your results.
So here's your action step. Before you make your next buy, sale, or budget update, take a hard look at your highest cost units and run them through a true total cost of ownership lens. If you want a shortcut, reach out to Alliance Fleet Solutions. We'll review 3 of your costliest vehicles and send you a no-fluff plan tailored to this market.